we now welcome on board our next expert, Santanu Sengupta, India economist at Goldman Sachs, joins in the show right now. Santanu, great to have you today on ET Now. Santanu, just yesterday the economic survey pegged the nominal FY24 GDP growth at 11%, with real GDP at 6.5%. Wanted to understand, like I was chatting with Jahangir as well earlier, if that's realistic, you think?
Yes, thank you for having me on the show. We think that 11% is a relatively realistic number for nominal GDP growth for fiscal year 24. We are looking at a similar number in the budget estimates that we have built in. We think that real growth could be in the region of 6.5%, and thereafter, if you have about 5.5% out inflation, you would land up with a nominal GDP growth of about 11% for fiscal year 24.
Now, the other big question is Indian economy is growing, and Indian economy is growing at a run rate which perhaps is one of the fastest in the world. So the question is that how far do you think it will take, or how long do you think it will take for India to reach the $5 trillion mark?
Right. So if you think about 2023 in terms of a calendar year basis, from 2022 calendar year to 23 calendar year, our view is that you're going to slow down by about 1 percentage point. So you grew at roughly 7% in 22, you'll be growing in our view at roughly 6% in 23. But this slowdown is just coming back towards your potential growth. So we think India's potential growth is around the 6% mark. So I would think that you are at about trend or at about potential in terms of where you're getting to in terms of the growth number in calendar year 23 or in fiscal year 24. If you think about the $5 trillion mark, our view is that India grows in the region of about 6.5% over the next 3 to 4 years in the forecast horizon. Given the FX forecast that we have, we think that India can get to a $5 trillion economy by about 2026 or fiscal year 27.
Right. Santanu, the economic survey also flagged the current account deficit as a key monitorable given the possibility of rupee depreciation. I wanted to understand how is it that you're viewing this and what are the key macro risks that you currently see for India?
So in terms of the current account deficit, we are looking at the current account deficit in the region of about 3% of GDP. Obviously, depending on where oil prices ultimately settle, but the rough number that we are looking at is about 3% of GDP. Now, if you look at the current account deficit from the macro cycle point of view, you are trying to grow investments and you're entering into an investment cycle. At the same time, if you have a wide fiscal deficit, it's therefore obvious that the current account deficit will be wide because to fund the investment cycle, you will have intermediate imports of capital goods, transport equipment, and so on. This is even apart from where oil prices settle and so forth. So therefore, our view is that as long as India is growing fast or trying to boost the investment cycle, with a large fiscal deficit, you will be having a wide current account deficit. On the INR, though, our view is that you will see about 83 in the near term on the 3-month horizon on the INR, dollar INR, but thereafter we expect it to actually flatten out or appreciate a little bit towards 82. And the reason is because what happens ultimately to the dollar INR is a function of what our view is on the dollar. And we think that the dollar would likely weaken over the year 2023.
Right. Santanu, lastly, in your view, what are the 3 key metrics that investors here in India and abroad, of course, should look out for in the budget to assess how investor-friendly the budget is?
I think investors would be keenly watching the commitment to fiscal consolidation. As I pointed out earlier, it is important from managing your overall public debt to GDP, and it is also important to signal to the market how committed the government is on fiscal consolidation. So that's the macro risk part. The second thing that investors would likely be watching out for is how much of expenditure allocation, the government decides within this consolidation, of course, how much of expenditure allocation they decide on capital expenditure versus revenue expenditure. Our expectation is that the government, which has shown great commitment towards capex over the last few years, will continue with that tradition in fiscal year 24 as well. So capital expenditure we would expect to be maintained at 3% of GDP, which means it will grow at the nominal GDP rate. And finally, what the government decides to do on subsidies. The food subsidy part is well known. We'll have to see what the government does on fertilizer subsidies.
Okay. All right, Shantanu, really appreciate your time. So glad you could join us now. 9 o'clock, pre-open rates